Afternoon, everyone. My name is James Newman, and I run Global Business Development at WebN Group, the Alan Howard-backed incubator for Web3 and FinTech innovation. Today's panel is crypto through a macro lens, and I can't think of a more timely topic to end this conference on. Over a very short period of time, we've seen global central banks raise rates to significant levels. We've seen growth waning, inflation remaining relatively stubborn, whilst regional bifurcation and, of course, an election next year is creating a backdrop of rather a large amount of uncertainty. Clearly, the timing around any central bank tilt, in particular the Fed, is captivating markets both on the traditional and the digital side. And the ETH Bitcoin rally throughout the year has seen levels drop back to more subdued levels. This backdrop creates a number of risks, but also opportunities out there. And I think one of the most interesting things for me is the decorrelation between digital assets and the traditional counterparts. On the flip side, we've seen institutions entering the space, a number of asset managers looking to create digital asset products in the name of Bitcoin and ETH ETFs. And this has further blurred the lines between digital and traditional assets. There's clearly a number of different places in which we could kick this off, and I'm fortunate to be joined by a very special group of people here. I'm expecting this to get quite lively, so before we kick things off, I will kick this off with a round of introductions, starting with Alex.
On correlations, basically. The way I think about it is Bitcoin basically used to trade absolutely uncorrelated from equities and risk assets for basically a decade. And that changed in March 2020 with the arrival of basically Paul Tudor-Jones and a big slew of macro investors. And if you basically look at the charts and look at correlations, BTC equity, US equity correlations pumped up to basically from 0% to 30 to 0.3 to 0.5. And that broke down in basically April of this year. So that's one of the issues we have in this problem, which is basically that correlation broke down. That happened mainly because US market makers and then other market makers start stepping out of the market, therefore turning their correlation algos off. Basically, market makers, one of the ways their pricing models work, one of the main inputs is correlation algos. So when they turned those off, Bitcoin started doing what we've seen, which is basically nothing, right? So there's very little spot flows, and with equities ramping up, very little spot flows, poor sentiment, and market makers taking a step aside, we got into where we are right now, which is basically praying for an ETF. Right?
Yep. Taking a step back to kind of thinking a little bit more broadly about the kind of macro crypto picture and how that's evolving. Darius, would you care to share some thoughts on the themes that you feel are most important and the ones that you're paying attention to when you're investing?
Yeah, just to quickly introduce myself, my name is Darius. I'm the founder of QCB Capital. We're a global crypto trading firm, one of the first in Singapore to start trading digital assets. We provide our clients with institutional trading strategies and trading solutions as well. And we are one of the largest market makers for crypto options and derivatives around. Yeah, to answer your question, I think, I echo a lot of what Alex said. There generally is a positive correlation between crypto assets and equities. So you treat it as a risk asset. But March, April this year was actually very interesting. I think there was one time when the correlation broke properly, where you saw crypto rallying while risk assets sold off. And I think, for me, I think anecdotally, with the TradFi community, I think they started to take this seriously as a emerging asset class, where it's a possibly non-aligned, where it's a proper store of value, and it starts seeing it as part of the whole global macro story. So I think we saw that, but right now vols all over are kind of subdued, in a high interest rate environment, like James mentioned. So I think we're bouncing around a little bit here. Remains to be seen how this develops. The biggest issue with crypto right now as an asset class, I think, is the fact that the credit markets in crypto are a bit broken. We have a situation where the risk-free rate is 5+%, and the crypto rates are somewhere below that. I think we need this we need the crypto market, and previously it used to be the other way around in a big way. So I think we need the crypto credit markets to come back, bring some leverage into the space, have proper risk premiums, and to see activity again. With that said, the options and derivatives market in crypto has been growing in spite of spot volumes being low. So we see traditional players, guys like WebN, coming in a big way into this derivatives market, and I see that as a segment that will continue to grow as well.
Thank you. And you touched on credit markets and obviously risk-free rates. So I think that's an interesting segue into, Will, your thoughts on Fed central bank policy, more globally rates, and how that impacts the way that you look at investing, the cost of capital, and those such things.
Sure, yeah. I mean, I think a lot of this comes down to the market participants, and Darius talked about this some as well. It's, in a traditional framework, right, like if yields are high, investing in non-yielding assets is an opportunity cost, and so you see liquidity move away from the likes of gold or other, low-yielding stocks, and you could say Bitcoin as well, right, because it doesn't have a natural yield. And so I think, despite the fact that personally my view on crypto long-term, or even medium-term, is not impacted at all by the level of rates. Like, you have to respect the fact that, liquidity shifts how it's allocated, in a higher rate environment. And some of the correlation relationships that Alex was talking about, it's based on a narrative and something that's self-fulfilling, right? So if a lot of capital moves away from the asset class, whether it's market makers or allocators who, think, again, it's an opportunity cost to be here when rates are higher, then you have to respect that, flow of liquidity, even if it doesn't have a fundamental impact on, where the technology is going, where the adoption is going, et cetera. So a long way of saying, like, you absolutely have to pay attention and respect, Fed policy, especially for trading in shorter horizons. Does that fundamentally, change the trajectory of, Bitcoin or Ethereum, things being built on top of it? Like, I don't think so at all, but it certainly matters, and it impacts price over, medium to long-term horizon. And liquidity, without a doubt, has a huge impact on asset price. And right now we're in a very low liquidity environment, especially for the spot market. And as a result, it's short-term narratives and a lot of things that move price in seemingly kind of random or very gappy ways. And that's just the reality.
I agree with a lot of that. And Richard, in terms of Fed policy specifically, do you have any view on an underlying tilt? And obviously, liquidity in digital asset markets is relatively low or feels quite low on the spot side. What about dollar liquidity and how that's impacting crypto assets?
Yeah, I think, I mean, the reality is the Fed policy has been super aggressive in a super short space of time. And I think anyone with with any economics background would admit there's always a lag between interest rate policy and economic outcomes. It would seem the appropriate time from my perspective, although I'm obviously always slanted bullish being the long investor up here, that the Fed needs to take a pause at some point and kind of take the temperature on the amount of impact that it's had. I mean, it's raised rates from kind of 0 to 5-ish% in a period where you would usually, most economic textbooks would say would have very limited effect over this period, and you're really talking about an 18-month lag, which we haven't seen play out yet. So it would feel like the right sort of time to sort of pause upon that. I think from a liquidity perspective, you kind of got two factors when it comes to crypto. You've got the macro liquidity impact, which the guys have spoken about at a macro level, and then you've got the crypto-specific factors around number of market makers pulling out of the market, number of market participants pulling back. So you've kind of got that double impact across the market. And I would say, our 7 years in the market, from a relative perspective, this has probably been one of the lowest liquidity type markets that we've actually seen. Order books are extremely thin on exchanges, particularly for people looking to actually acquire volumes in either direction. It's extremely thin markets at this point, so which is kind of an interesting time. So from our perspective, always slanting bullish, these are generally the times when value emerges. These are the sorts of times where, to Will's point, when you can look through sort of longer term cycles and you can look through sort of longer term trajectories, these sorts of shorter term impacts are the sort of periods that allow you to sort of find those sort of real differentiators in your portfolio.
Yeah, and Darius, in terms of this low liquidity, how is that affecting market structure? And what are the vol markets actually saying to you in terms of price action in the majors, Bitcoin, Ethereum?
I think market structure is evolving and developing in spite of liquidity. I mean, liquidity is fragmented in the crypto space, partly due to regulations and partly due to the fact that there is, there are many segments to it, CeFi, DeFi, different, and private exchanges and whatnot. But I think, market structure is developing in spite of the poor liquidity. We have players who are developing infrastructure solutions, trading settlement, clearing. I think people working on the rates market, trying to find a way to get a rates curve. And I think that, one thing that interests me, and I think I'm quite optimistic about, is there are segments within crypto that are native and unique to crypto. Staking derivatives that you don't have in TradFi. So I think we are developing new methods of looking at interest rates as well. Remains to be seen how that plays out. Clearing through CDFI hybrids are quite interesting as well. But yeah, market structures are definitely maturing. In spite of the credit bomb, that we saw last year, right? Derivatives markets, options markets were robust throughout. So I think that was one positive thing that came out of last year. And we see these going strong. On the option side specifically, you have more and more exchanges, Binance, Bybit, Bit.com, OKX, all starting to develop options as well. Starting to see regulators pay attention to it. Several banks have started to trade options, crypto options specifically. And I think, very soon we'll be seeing some of these guys distribute as well. So I think the pieces are falling in place. I think, it's a bit of a journey. We still need the regulators to put the pieces together. And on the native side, we need to be open to working with institutional guys, with banks. We can't avoid them. It is a capital market after all. So I think, things are falling in place with new unique features as well that are native to crypto.
And with institutions and banks entering into the fray, offering certain digital asset products, obviously the benefits of, call it portfolio diversification, come into fray. Richard, from your perspective on both the kind of VC and liquid side, how do you think about that when you're thinking about deploying capital?
Yeah, I think the market moves in, from our perspective, different cycles, right? And if I look through the journey, we look at the correlation between assets and the segmentation of the market. I think for the sort of first 5 years or so, had Bitcoin trade somewhat uncorrelated to the rest of the market at points in time where the rest of the market was weaker. And if you look back 4 years, 2019 was a good example of that. Bitcoin's up about 100%. And I think the entire aggregate of every other coin was literally zero when you add them all up. When we look at the market today, 4 years on, we're actually probably seen a pretty similar market in 2023. I guess the key difference we'd see is that Ethereum seems to have matured and kind of joined the big kids table, and it's trading like Bitcoin did in 2019 in terms of much stronger than smaller cap or outside of those two mega cap coins. I guess it's trading. The rest of the market's relatively weak, and I think that's reflective of the flows, right? So if you think about it from a macro perspective, hedge fund allocations to crypto, they make the decision to allocate capital to crypto, and then they buy Bitcoin, and it appears they buy Bitcoin and now they buy ETH. They don't really think much further about it because for them the key decision is the allocation to crypto, not spending time and resources going further down the stack. That's the decision they make. As we move into, I guess, a market more driven by growth, as crypto starts to sort of drive the user adoption, the sorts of revenue growth that we'd like to see over the next few years, you start to attract, I guess, a more fundamental-driven investor that's not just allocating a small portion of the portfolio to crypto. They're looking to actually add alpha within that allocation as well, and they've got the resources and the time to actually go further down the stack. And in our experience, that's when you start to see, I guess, the altcoin market, for want of a better word, start to provide differentiation, and you start to see some real sort of alpha generated as people start to sort of find the specific assets that are driving sort of real adoption and real growth.
Yeah. Will, Alex, have you got any thoughts on what Richard said?
To be honest, the acoustics are really bad. So unfortunately, I missed a big chunk.
In terms of, so to carry on from what Richard was talking about, if we think about the changing macro environment and also the changing interest rate perspective in an asset portfolio point of view, How do you think investing has changed for those looking to run a diversified portfolio, looking to include traditional assets and digital assets? And how has that changed from a low interest rate environment to a high one?
Perfect. On one hand, an issue that we have with basically dropping correlation of Bitcoin is that by having an unstable correlation, it makes it very hard for institutional allocators that they're basically in their portfolio construction, they're targeting certain volatility levels. So if you don't really know what the correlation is because it's massively variable, it's pretty hard to determine what level of BTC exposure you want to have in your book, in your portfolio. That on one hand. On the rates side, I'd say that what the theme, which is, I would presume that all here agree that it's going to be the case, is basically interest rates higher for longer. What that mainly generates, it doesn't mean that the economy has to crash or risk assets are going to be basically in the doldrums forever. What that actually means is it produces a large set of winners and losers. So the phrase I'd use is dispersion is the name of the game. And when it comes to basically, so thinking about that on the equity side, you have to think that basically commercial real estate, banks, and profitable tech going to suffer while everything else, I'd say, or most other sectors continue going up. I'm particularly very, not at these levels very bullish, but I'm bullish on both growth, and I'm bullish on risk assets as a whole. And finally, when it comes to crypto, having basically interest rates this high, what it means is that it pushes projects to try to generate revenue and focus on revenue, because if you're not making revenue in this market, you have a problem. We don't like you, pretty much.
And I would just piggyback on some of what Alex said. I think dispersion like this is like one of the healthiest things that we can have as an asset class. Like it feels like a terrible year in some respects in terms of aggregate performance, and you have very few names that are doing well across the board. At the same time, if you look at the fundamentals or the potential for a lot of projects within crypto, there should be a lot of dispersion. There should be a massive delta between the winners and the losers. And when you're in a low rate environment, in a bull market environment, and everything's getting funded, you don't really see that. It's just all kind of one trade. And so I think it's a very healthy thing to see that dispersion. And frankly, if there's institutional investors that want to take the asset class seriously, it's also helpful to have that level of dispersion so you can see what are the things that are, again, being adopted, have characteristics that you want to invest in. So while it's painful from some perspectives, and all my bags aren't doing great as a result, again, I think it's one of the better developments for crypto through this cycle. And then actually to Darius's point, the market structure has evolved a lot, but the nice thing is within DeFi broadly, right, there's a lot more options now to express views in terms of longs and shorts, perps, et cetera, that are not tethered to having assets on an exchange. And again, that also helps reinforce this, express views, have more dispersion in the market. So I think it's a very positive development in a otherwise kind of brutal market at times.
Yeah, and I think Alex touched on it. Higher interest rate environments seem to affect the type of projects that are being built. Will, what's your thoughts on kind of CBDCs, stablecoins, and the drive for profitability of new projects coming out in the arguably crypto bear market, and also for those existing projects? How does capital coming into that space view those?
One thing I'd like to talk about is I'm not answer your question directly, but stablecoins. Stablecoins are one of, if not the killer crypto killer utility. It's extremely useful, and it's transformed how people move money around the world and how some countries actually trade among themselves. And I often talk about this because I come from traditional finance, and still most of my circles are not in crypto. And I face repeatedly nowadays conversations that I had multiple times through the years in the past, which is basically, what has crypto to prove? After 15 years, there's nothing going on. Well, we have stable coins, and they work extremely well. That being said, It's very interesting. There's a lot of people right now, a lot of projects coming up with stablecoins, both in Asia and in Europe, and in Latin America, actually. I know projects in Brazil, well, actually almost everywhere. One thing that is very interesting on the stablecoin side, I think that is very important to issuers to start passing on interest to holders. That's a problem we have. Mainly USDC has a big problem, which basically it doesn't make much sense for you to be holding USDC for longer than you really have to for practical reasons, because you're basically losing 4.5% spread. And it's not, and with this kind of stuff, it's not that difficult to actually implement that. All Circle has to do is basically take their interest and use that to mint new coins and basically rebase supply and give those extra coins to holders. And voila, you have basically USDC holders receiving interest. Why is it not happening? I don't know.
So you touched on something interesting, which is obviously everyone's well aware that the macro picture can affect crypto asset prices, but vice versa. Do you think crypto, and where do you think crypto has its most impact, arguably on the macro, the geopolitical?
On the stablecoin side, on the most impact on what? Sorry.
Impact on geopolitical, the macro side of things, because obviously you touched on it in emerging
I
markets.
think we're a little bit too far away from that point for BTC to be a reserve currency. I believe it's going to happen at some point. I think it's a high likelihood that, say, in 15 years, major countries have BTC as a reserve currency. 15, 10, I don't know, but I think it's going to happen. It's a matter of when, not if. But we're too far away, so at this point, from a geopolitical perspective, I don't think there's much substance aside of.
Actually, with that said, you know, when Russia invaded Ukraine earlier the year, if you look at all the DeFi stats, you saw big surge in Russian and Ukrainian IP addresses coming onto DeFi. So you're right. I don't think it's any material impact per se, but there is this narrative that Bitcoin, Ether, crypto in general, is forming a non-aligned or non-sovereign asset class. You know, and I think that comes into play as we go along as well. You know, whenever there's geopolitical crisis, it could become a safe haven kind of asset. So it could be a two-way sort of correlation here.
We haven't seen a truly sort of fungible global asset class before. Traditional finance, apart from the absolute mega fund perspective, is very much geographic driven. You know, most people put their retirement savings into their own domestic markets, for example, right? Which, in a digital world with digital information starting to feel odder and odder as we go through each year. We're now moving into an asset class where you can buy a Bitcoin in Argentina, sell it in Australia, and get a market made by Darius in Singapore on the same asset in the same 30-minute cycle, right? And the world's never had that before. And so I think that's just a natural evolution of what digitisation of the world does. It makes sense that we have digital assets to go with the digital revolution we've all been living through for the last 30 years, and we'll probably live through for the next 50 years. So if I was to look at a macro level, what's the most impact it's had? It's really that sort of wake-up call that we're in a digital world now that should be borderless in terms of where assets trade and how they're traded and how they're owned. And crypto is really the only example of that today.
I think to add on to Richard's point, I think one more very important thing is, if a simple case of, let's say you compare margin levels on CME versus margin levels on Deribit. Right? Imagine that the leverage on CME is 3 times, Deribit's probably 5-6 times in general. So you are talking about the use case of crypto here, right? Crypto being a constantly settled and constantly cleared asset class versus CME being an end of day over the weekend, and then the time and the delay in settlement is being expressed in the cost of margin. And the fact that crypto exists and its real-time settlement is forcing people to think about this change. And you start to see when the two markets start to overlap, it's going to reduce margin costs for sure. So I think this is a small but could be very impactful.
Actually, I just wanted to add exactly the same. That's the second killer app of crypto, 24/7 liquidity. It's amazing.
And I wanted to, you were talking about the geopolitical consequences, and I think we're all aware of the narrative around Bitcoin as it relates to having this independent currency and like the freedom that it provides. I would argue right now, actually, stablecoins have much larger geopolitical consequences than Bitcoin does. Like I'm actually on a panel/working group next week, which is Modern Crypto Warfare: Dollars versus Bullets. That's the name of the working group, right? But it clearly is alluding to the fact that it's no mystery that the U.S. uses monetary policy and dollars and sanctions, right, as a way of fighting wars and having influence. And so dollar-based stablecoins are potentially a big part of that. And so again, I think in the near term, while it's still a very much, dollar being the reserve currency of the world, I would argue that stablecoins are much more relevant as it relates to geopolitical, discussions and narrative than Bitcoin. Although I'm also fully on board with the longer-term trajectory of Bitcoin and the role it plays there.
While it's not specifically on topic of macro, I think it's probably worth giving you mentioned the US dollar and regulation. Just touching on this briefly. Will, what do you think are the main areas that one should be watching around regulation going forward, and how might the macro backdrop fit in here? Arguably, could the macro backdrop affect policy in the US, but a bit more globally?
Yeah, I guess I'd just make a few points that are related to that. I think one, I think there's this impression that there's a cohesive view on the place of crypto within the US and amongst regulators. And I think, in fact, there's no cohesive view. I think even within Congress, there's different views. The Fed wants control over stablecoins, right? Because even Michael Barr mentioned this a couple days ago. Like, he's concerned about stablecoins broadly in terms of it supplanting the dollar. The SEC, of course, has its own agenda, which I think has been weakened recently. So I think, in general, there's no strict one view, one policy within the U.S. as it relates to crypto and regulation. I think also, again, which is not talked about much, but like this panel I mentioned for next week, I mean, there's a lot of people that are attending that are part of like the national security apparatus of the U.S. Like, it doesn't go unnoticed, the relevance, again, of stablecoins and how we could potentially use this. So I don't think I answered either of your questions directly, but it's very much a focus of regulators, each of them kind of trying to vie for power over the little like fiefdoms, which as a result, there's not really one consensus view. Hopefully that works out for the best for all of us, because there's, Gensler doesn't get his way, and there's thoughtful people that are thinking about this regulation on the US front. But
do you have any view on when US crypto policy may get a little bit more accommodating?
Sorry, say that again?
When US crypto policy might be a bit more accommodative?
Well, I'll say this. It seems most recently, when you look at like the case with Ripple or with Grayscale, one of the common threads there is that they're saying existing legislation is not sufficient, and it's not the SEC's purview to create legislation to do this, and thus it's Congress needs to step in and create legislation. So whether or not that regulation that they come up with is accommodative or not, I'm not quite sure. I'm hopeful, though, that it is, and we've had enough time now, and we understand the relevance of it, whether for national security or for other reasons, or just wanting American dynamism and being a leader in technology globally. Hopefully, all those factors play a role. Again, in some respects, maybe we'll have benefited from it taking so long, so much regulatory ambiguity for so long, that the space has matured enough that people appreciate the value, and such that we have a more thoughtful regulation. But I think what you're going to see now is over the next year, this get pushed towards Congress. We've got a number of bills in play already that are being, reviewed, talked about, et cetera. Nothing that's imminent, but I'm hopeful on that trajectory, but don't have a strong view on when it's going to be more accommodative, per se.
I think it's not a new thing for disruptive technology to be a struggle for regulators to keep up with, right? Like, if you look at even the launch of the fax machine in the 70s, it was illegal, which is mind-boggling. I think even till the early 80s, it was actually technically illegal to send a fax direct to an end receiver. You were supposed to send it through a US post office. So you're supposed to send a fax to the US Post Office, it was then supposed to deliver it to the recipient. Now, of course, no one did it because it was mindless and ridiculous legislation, but that gives you an example of like how slow regulation can be to keep up with technology. PayPal, Uber, crypto is just another evolution of disruptive technology that is moving way faster than regulators can. So I think, from our perspective, we think regulation continues to evolve, but when regulation catches up to where we are today, crypto's not going to be in the same spot. So you're always going to have a lag until crypto gets to a more mature, lower growth type environment, which I don't think we're going to be in for some time.
And I think with institutions clearly entering the space, I think that discussion is going to speed up, arguably. The two big use cases there are ETFs, which in this conference there's been a number of others applications announced. And the second one is real-world asset tokenization. Those are the two major things that a lot of major institutions seem to be focusing on. How do you think that the macro perspective or the macro picture feeds in there? Will policy drive this from the crypto side? And do you have any views, Richard, on an ETF approval?
Yeah, I think answering the first piece around real-world assets, I think one of the things rates has created is actually an environment where the settlement layer and the speed that crypto provides can actually start to be a super competitive driver of growth. And we're seeing that through MakerDAO as one example, right? Where the cost of effectively warehousing debt on MakerDAO now is incrementally cheaper than doing it in the real world. And that's the first time that we've sort of seen that environment, and we're starting to see, and that creates an impetus for people to take that step to embrace a new technology, push it through the compliance department, have the risk discussions. It's not just because they want to try a new tech, there's actually margin in it for them, right? And so you start to see those interest rates. One of the positive aspects, it starts to make crypto much more competitive at that sort of level. When it comes back to the ETFs and those sorts of things, I think ETFs, because there's ETFs already in a lot of markets, right? And I think the reality is if ETFs, from our perspective, if ETFs had got approved in 2017, that would have been a massive step change for the industry. But clearly, a bunch of exchanges, a bunch of distribution platforms have made it easier and easier to buy crypto every year. So the incremental benefit of an ETF, in our view, has probably decreased. Now, having said that, there's clearly a big part of, conservative money that wants to buy assets using the same platform that it does with its equities and its bonds, and an ETF is super helpful for those people, and they've got a bunch of money. So that is, pretty good inflows to the space. And I think it does give a sign of where the regulators are. Once you've got an ETF, it's effectively a sign of, it's somewhat of a validation of the asset. So we would say where we are now, from our perspective, the approval of an ETF is actually more of a regulatory positive than a flows perspective, although it is positive from flows as well.
Given there seems to be a fair amount of, call it positive news to come, arguably if you assume that an ETF approval or spot is going to happen, whether it's this year or next year, what do you think are the major kind of systemic downside risks out there that you're worried about from an investment perspective? Darius, if you'd like to go first. Well,
the near-term downside risks are still quite regulatory in nature. You have DOJ going after Binance, or DOJ, SEC, CFTC going after Binance, being hostile. FTX liquidating assets, the Mt. Gox liquidation that seems to be forever being delayed. So everyone's sort of waiting for that to clear up. But structurally, I would say that we are quite bullish as well. I think once we get over these supplies in the market, I think there are positive narratives, the halving being one, the spot ETF. I agree with Richard that materially, effectively, product-wise, is not anything that new. But if U.S. banks start to get allowed to trade spot, and it just creates a whole more positive regulatory framework, like you said. I think the guys like all the HFT guys are waiting for that to come up as well, and then they jump in. So increase participation, increase activity in the space. I think that can only be good. So I think just some of these supply issues to get over, and I think we're quite systematically bullish as well.
Great. And Will, anything you're worried about?
Yeah, I was going back to your question on the view on how regulation would become more accommodative. I actually think the entrance of BlackRock and these institutional players and their application for an ETF is probably one reason to be optimistic about the regulatory path. you can be pessimistic and say that some of the pushback from regulators has been in part to give time for traditional players and incumbents to catch up. And now, you could say that they're sufficiently caught up, they're making these applications if NASDAQ's going to offer a custody solution. So I think from that perspective, you can think it's more likely than not to be more accommodative, here on out, now that everyone's got time to get their ducks in a row. I do think just even looking at the testimony or this hearing with Gensler earlier this week, he's getting slammed pretty hard from every angle. So I think the probability on an ETF sooner than later is probably there. And yeah, while it's not that novel for people who are in crypto, it's unquestionably like the convenience factor for someone who knows nothing about crypto to be able to buy something in their retirement account. Like it's hard to ignore the relevance of that from just flows coming in.
And on the more positive side, outside of the kind of known unknowns, i.e. potential ETF approval, Bitcoin halving, are there any themes out there that you think give you that kind of right tail convexity that aren't necessarily being appreciated by the market, that aren't priced into current asset prices? Alex?
Well, actually, it's very obvious. Is the ETF somehow we're trading at the exact same level as when the news hit us in this was mid-June. It's absolute insanity, but here we are. So it's incredible. It's such an obvious trade, and it's not priced in. Odds, in my humble opinion, are about 70%. That happens in January, not before. It's before January, all the delays and everything are irrelevant. And then January, it's we get it or we don't get it. And something that I think the market is not talking about on the ETF side, and something else on the ETF side is back to what I was saying at the beginning, that Bitcoin ceased to be a macro asset. Once we get an ETF, Bitcoin will be a macro asset once again. So it's going to change everything. That on one hand. On the downside, something that worries me is not Binance itself. I think the settlement of Binance would likely be something akin to what happened with BitMEX in 19. What worries me is the fine that CZ may get. And if it's a multi-billion-dollar fine and he's forced to sell in the short term, we have no idea. We're just guessing here. Say he has to dump billions of BTC and BNB. Okay, that is not in the price. So, yeah.
I would say the Bitcoin ETF and halving are being priced into the options market. So the Bitcoin option curve is steep. It's about 15% between the front and back end, very steep. And Bitcoin options are 7 vols higher than Ether options as well. So maybe absolute price-wise, not that much priced in, but the option market is sort of reflecting some of this volatility. But yeah, your point on CZ, I hope he can afford it. So
yeah. Should have asked him earlier.
I guess that was when we all do 4 at the same time, and the crowd as well.
So, one last question to everyone, and answer how you feel comfortable. But looking to the end of the year and also 2024, what is your view on asset prices in crypto? If you're comfortable, any levels that you're looking at in Ethereum and Bitcoin? Starting with you, Alex.
BTC end of year 28.5, and next year 37, 42, and if we get lucky, more. One thing about as a directional trader, picking the exact level is usually detrimental for returns. It's different if you're an options guy, where basically you're going to be structuring structures around levels and volatility. So if you're a directional guy, it doesn't matter as much. So I don't really care if it's going to be 42 or 47 or 180. I mean, yeah.
My base case is a slow grind higher towards 30K in the last quarter. There's some seasonality for positivity in the last quarter. But if we have, I think on an ETF, positive ETF announcement, we probably have a nice knee jump to 35, just based on where the gamma levels are.
I think putting, specific price levels to one side, I think what we're excited about is, and Alex made this point earlier, that the interest rate environment, the capital raising environment is driving a lot of projects to really focus on speed to revenue and speed to kind of self-sustainability. And we're seeing a lot of that at the moment, and that's probably one of the key themes that we see, particularly through the second half of this year into next year. Some real differentiators at that sort of the smaller cap, mid-cap level of projects that are really starting to make tens to hundreds of millions of dollars per year, right? And we think that can kind of drive, I guess, a new mindset around crypto and attract a whole new set of investors, not just so much momentum driven. It's crypto dragging investors because it's fundamentally cheap based on the amounts of revenues and users it's generating. So that's where we see the most positive outcome over the next sort of 18 to 12 months.
Will?
Yeah, I don't know if I have a sophisticated way to answer this question. I do think, if there's a negative outcome with Binance in terms of negative impact on liquidity, I think that will have a pretty big impact, of course, on price, but also sentiment for some period. Not any different than what we saw last year with FTX. And so I think in that scenario, we're probably flat to down from here. I'm more optimistic than that, and probably would say 28 to 30, but that's not,
Brilliant.
Take it for a grain of salt.
Cool. Well, thank you everyone for taking part, and thank you everyone for attending.
James, so one question. You?
Yeah,
I think towards the end of the year, slightly lower, but throughout 2024, similar levels to you guys. Cool. Thank you, everyone.
Thank you.